So many people have the goal of becoming rich, but they keep doing the same things over and over again and expecting a different result. In fact, the majority of people fail to recognize that their capacity to increase their wealth depends on the decisions that they make on a regular basis. Simply put, whatever financial situation they find themselves in is a result of these decisions. Fortunately, a little education can help us steer clear of these bad choices. And I'll share 7 financial mistakes with you in this video that will ruin your finances. First mistake, working to earn money rather than learning. The primary reason people work is to get paid while making money is good. Your financial stability will suffer if your paycheck is your only focus. You must be open to learning while working. Some people exaggerate their experience, saying they have 20 years of experience when in fact they only have 1 year of experience that they have 20 times. When people only work to earn a living and not work to learn, this is typically the outcome. One of the typical errors that most people commit is this one. People go to work every single day, but their only concern is their paycheck at the end of the month. As a result, they put in just enough effort to retain their jobs and get paid. They have no interest in making improvements to themselves or the organization. You end up doing a job that you have little to no passion for when you're working to earn money rather than learning something new. You'll typically notice that you detest your job so much that you can't wait to get out of the office. The majority of those who work 9 to 5 are in this situation. They complain constantly throughout their working hours and only get to have fun on the weekends. Such people usually don't have a happy life, and they are the least productive at work. You can fix this error by altering the way you view your job. If you work to learn rather than to earn money, you can enjoy your job. Because of how quickly the world is changing, you cannot afford to stop learning about your industry. If not, you'll soon lose your job or be unnecessary. Think of someone who's only proficient with a typewriter and is unwilling to learn how to use a computer. You agree with me that such a person will soon lose relevance in the workplace. When you work to learn, you become more qualified and build new skills as you go. That will make it simpler for you to advance in your career or even request a pay raise from your employer. When they recognize the value you bring to the company, they will be happy to give you one. And if they don't, it won't be difficult for you to find another job. You have the option of switching to a high-paying job from a low-paying one. Mistake number 2, spending on consumables rather than assets. One factor that affects your finances is where and what you spend your money on. It is possible for 2 individuals to work for the same company, living in the same neighborhood and earning the same amount of money, but one will be debt-free and the other will be in debt. What they purchase with their money makes the difference between the two. One may choose to invest in assets while the other may choose to spend their money on consumables. Consumables are items that you purchase with money for immediate use, but that don't provide a financial benefit or return. To buy and keep some of them will actually cost you more money. Liabilities are what we call them. On the other hand, assets are the things that you invest money in that grow in value over time and may even be able to make you more money. The main distinction between assets and consumables is that while consumables do not add money to your bank account, assets do. Most people prefer to buy consumables over assets when spending their money. They then ponder why they are not in a stable financial position. The reason is that whether you become wealthy or not depends on the difference between your assets and liabilities. You shouldn't anticipate having the same amount as someone who spends their money purchasing more assets if you spend more on consumables. The common reason why people spend more on consumables is that they either cannot suppress their impulses to buy or spend money to improve their mood. Instead of meeting their needs, they buy things to give them instant gratification. But in order to become wealthy, you must learn to limit your spending to necessities and to curb your desire to flaunt your lifestyle. You are not able to. Mistake number 3. Having debt is one of the things that most people fear. But more than half of the population is in some kind of debt. One of the errors people make is believing that all debt is bad, and as a result, they live in constant fear of debt. The wealthy use debt as a tool to accomplish more than they could with their own funds. Don't make the error of believing that all debt is bad because it can financially ruin you. Debts with the potential to raise your net worth are considered good debts. Bad debts, on the other hand, are those that can lower the value of your assets or those used to purchase liabilities. Business loans are an example of a good debt that you can use to grow your company and boost your earning potential. Any loan or debt that can help you earn more money is considered to be good debt. However, Bad debts are used to get things that don't make you any more money. This includes taking out loans to buy a new car when you don't need one, as well as spending money on consumables, designer clothing, and upscale dining. The fourth mistake is letting fear prevent you from achieving your goals. Unbelievably, a lot of people will hold themselves back from success out of pure fear. Fear stands for fake evidence that seems real. This means that although fear seems real, it's not. More people have been prevented from succeeding by fear of failure than by actual failure. Fear stops you from taking risks and therefore stops you from becoming successful. When you are in your comfort zone, fear keeps you there, making action difficult. Fear is the enemy of success, but it's also bad for your health because it makes you feel physically unwell by making your heart beat faster, your throat dry, and breathless. These are all signs of fear that can affect your health, thereby causing low productivity. Fear is a result of uncertainty and a low sense of worth. You need to believe in your ability to take action. Start by asking why not, rather than making assumptions. It's acceptable to anticipate challenges along your path to success. Instead, make the proper preparations. As a result of making these preparations, you'll have faith in your ability to handle any challenges that may arise on your path to true wealth. Relying on one source of income, mistake number 5, is one of the mistakes that can quickly leave you in financial ruin. Everything could happen to your sole source of income in the uncertain future. Your savings will be spent, and before long, you'll be in debt. Therefore, if you want to be financially independent, you should think about having multiple sources of income. Everything could happen to your sole source of income in the uncertain future. To diversify your sources of income, there are various approaches that you can take. One of them is to establish a business while keeping your regular job. Starting a business doesn't require you to resign from your job. You can run your business while keeping your job, and if investing in a physical store is too expensive, there are other options to explore. Online companies come in a wide variety. You only need a small sum to get started. You can create a YouTube channel, a blog, or even a book that you can sell online. Renting out a room in your house is another way to generate an additional source of income. Your financial situation can be significantly improved if you start renting out an unoccupied bedroom. Ideally, this additional income will enable you to increase your savings levels and pay for some essential expenses. Sixth mistake, neglecting to prioritize debt repayment. Even though the majority of adults today are in debt, very few of them have the intention of paying it off. Setting debt repayment as a top priority can make the process much simpler and quicker. The benefit of setting a goal to pay off your debt is that it will help you concentrate on doing so without sacrificing other crucial financial objectives. The good news is that paying off your debt doesn't require you to spend all your savings. The first step is to determine your overall debt balance. This will enable you to calculate the minimum monthly payment that you must make in order to reach your financial objectives within a given time frame. Additionally, you should prioritize repaying debts with higher interest rates over those with lower interest rates. By doing this, you'll reduce the amount of money you pay in loan interest. When creating a monthly budget, it's important to include the amount you intend to use to pay back your debts. This will help you pay off your debts more quickly. While you're working to pay off your debts, you should also take steps to avoid accruing more debt. You can accomplish this by setting a budget and binding your purchases with a list that will stop you from making impulsive purchases. Seventh mistake, enrolling in the same degree as all of your friends. What degree to pursue is one of the hardest decisions that you'll ever have to make. You'll frequently receive advice from family and friends about whether attending college is the path you want to take during this process. They'll cite factors like your chances of finding employment after graduation, your pay, and your level of job satisfaction. These are all important factors to take into account. But one error that impressionable young adults make is associating college degrees with their friends. This often leads to obtaining a degree that you dislike and working in a career you can't stand. You should pursue a degree only if it aligns with your personal needs and goals rather than doing it just because your friends are doing it.